Rob Gill here, CEO of Epic Financial Strategies, and today we're going to dig into what is true and what is not true and how the mindset can be part of infinite banking. 3 myths and 3 facts, what you should consider and how you should make your decision. What are the 3 myths? Myth number 1, life insurance is only for a death benefit. Well, listen, that's term insurance, which is usually 10, 20, or 30 years. For example, you could be a male, 35 years old, $1 million death benefit could cost anywhere based on your health between $50 and $100 or $200 a month. But eventually, when that term expires, so does that death benefit. If you want to keep it, it's going to cost a whole lot more money, and that's why 99% of term policies expire worthless. With that, though, if you stick to the end, we're going to give you an opportunity to do a deep dive and get a full education on exactly what kind of insurance to buy and how to look at how to buy it the right way. But just keep in mind, term insurance is for death benefit purposes only. There are other policies that are for the financial Swiss Army knife strategies that we always like to talk about. Myth number 2, young people do not need life insurance. Well, listen, the younger you are, the stronger, the bigger, and the better policy you could get, including your rating in general terms. Obviously, if there's a health issue, that's a different situation. But even if you're older, what's important to understand is that life insurance can serve as a wealth transfer later on in life, but during these wealth accumulation years, you're allowed to use that money for other opportunities. And even if you're younger and you're saving $200, $300, $400 a month, and you're 21 years old, by the time you get to 25 and 30, you're going to be saving more money and you're going to be building up that cash within these policies that's going to allow you, the young entrepreneur, to use that money for other opportunities. Myth number 3, life insurance is a scam. The only scam is term insurance that expires worthless 95, 97, 99% of the time because it's not building up cash value and there's a term limit on when it's going to be done. Life insurance, no matter what kind, is only valuable if it's active when you need it. Those that feel this way probably don't understand the power of permanent life insurance designed the right way, which we're going to get into. But here's the point, folks. When you buy the right kind of insurance that sits and fits with your overall financial strategies within your financial mosaic, what's going to happen is you're going to be able to buy things on discount, especially if you understand the ebbs and flows of the economy. When winter comes knocking on the door, but you got a boatload of cash, you're going to put yourself in a position to prosper. What are the 3 facts? Non-traditional whole life insurance must be overfunded, mutually owned, dividend paying. Let's talk about overfunded. Your policy is structured in a way where you are maximizing cash value, increasing the living benefit, and minimizing the insurance component as much as you possibly can. So what does that mean? Okay, if I have a premium that's $2,000 a month, but I'm sitting on $100,000 in my savings account, and this is going to be used, this $100,000, to go buy a rental piece of real estate. What I want to do is wire in that 100. Even though I'm paying $2,000 a month, wire in the 100. I'll be able to access typically 90% of that 21 days later. So 21 days later, I'll wire out 90, use that as my down payment on the piece of real estate. Now, the real estate has its own separate rates of return: cash flow, mortgage interest write-off, depreciation, and appreciation. So now when the renter pays back the mortgage or the policy, we're going to pick up not only rate of return there, but also interest and dividends along the way. Fact number 2, mutually owned. A mutually owned life insurance company is owned by its policyholders, unlike stock life insurance companies who are owned by shareholders who may or may not be policyholders. Stock companies tend to be focused on generating profits to distribute as dividends to shareholders, not you, the policyholders. So let's unpack this. If you look at a stock life insurance company, they have shareholders who are before the policyholders, right? And that means the company needs to come out with quarterly profits. So instead of just focusing on long-term 20, 30-year investments, the way a mutual life insurance company works, what's going to happen is these folks are going to get into mortgages or get into other things that are outside of why they first became a life insurance company in the first place. They're going to have certain debts, and they're going to be more risky with the style of how they invest their pool of money. A mutually life insurance owned company, which is owned by all the policyholders, they have a 30-year mindset, maybe 20, maybe 40-year, and their economic strategy has stood the test of time since 1850. Fact number 3, a dividend-paying whole life insurance policy, also known as a participating whole life policy, is a type of whole life insurance that can pay dividends to the policy holder. So on a yearly basis, you typically, if you're with the right kind of carrier, you'll get a dividend that is part of the profit share of the overall company. So the company makes money, they take that money and they share it with all the policyholders. This dividend becomes a turbocharger within the policy because you can either take the check, you could buy more insurance, you could add it to your cash value, leverage it, and do other things. But it's something that really gives you not a guarantee, but as close to a guarantee as you can get, because there's carriers that haven't missed a dividend paying in 150 years, but then there's other carriers that for 120 years, they maybe missed it once. So you want to really understand who the mutual life insurance company is, what their track record is, and in that scenario, if it ties into your overall financial strategies, you're going to put yourself in a position to make good decisions. So folks, thanks for sticking around, and if you want to learn more about infinite banking, and you really want to get a handle on this, we have a course. If you click the link in the description, fill out all your information, and this course is a deep dive, I dot and T cross and strategies on how to really do it, what to look for, what company to look for, how to overfund it, what does it look like when you overfund it. It is worth every single minute that you put into it to really get this education, and it also teaches you what questions to ask when you come in front of an insurance agent specific to infinite banking or become your own bank. Once again, like, share, and subscribe, and thanks for checking us out.